Dream house just quietly turned into a financial trap, and most buyers haven't noticed yet. For years, the script was simple: buy as soon as you can, prices always go up, and if the payment hurts, you'll just refinance later. That script is still being repeated by agents, lenders, and relatives at family dinners, but the math behind it has completely changed. The mortgage market has flipped, and the people most at risk are the ones still playing by the old rules. In 10 Ways the Mortgage Market Just Flipped, we're going to break down what's really going on behind the smiling "you're approved" emails. Monthly payments have exploded, prices are stubborn, and lenders are getting creative in ways that help them move loans, but might lock you into decades of stress. On paper, you qualify. In real life, you're one job hiccup away from a financial migraine. Right now, a lot of buyers are walking into this market thinking, if I don't buy now, I'll miss my chance. That fear is exactly what makes them overlook the fine print: higher rates, fragile budgets, risky products, and a housing game where the downside has quietly shifted onto their shoulders. We're going to talk about why the old advice no longer fits this new environment, how "marry the house, date the rate" became a dangerous meme, and what you actually need to look at before signing a mortgage in this market. Welcome to Virtual Finance Navigator, where we unpack money decisions without sugarcoating the risks, but also without telling you to live in fear forever. If you're even thinking about buying a home soon, don't click away. Watch this to the end, hit like, subscribe, and drop a comment with where you are in the home buying process. This information could be the difference between owning a home and owning a very expensive mistake. For years, the home buying playbook was basically grandma's recipe card, worn out, passed around, and everyone swore by it. Step 1, just buy as soon as you can. Step 2, real estate always goes up. Step 3, if the payment is high, you'll refinance later. Step 4, you'll thank yourself in 10 years. That old playbook was written in a world where home prices were lower relative to income, interest rates could reasonably be expected to drop over time, and starter homes didn't cost the equivalent of a small spaceship. A 30-year fixed-rate mortgage at 3% made a lot of bad decisions look brilliant in hindsight. Now the environment has changed, but a lot of the advice hasn't. That's the problem. Today, you've got home prices that climbed aggressively, mortgage rates that jumped and refused to fully come back down, and incomes that politely lag behind. The "just buy now, you'll grow into the payment" logic hits different when that payment is 40 to 50% higher than it would have been a few years ago for the same house. That's not tight for a while. That's hope your car doesn't break down. The old playbook also assumed mobility. If you didn't like the house, area, job, or payment, you could sell, move, or refinance your way into something better. But in a world where a lot of current owners are locked into ultra-low rates and new buyers are stuck at much higher ones, the flexibility is gone. You don't just upgrade anymore. You trade a mortgage that hurts for one that hurts more. On top of that, lenders and markets have gotten more creative. Rate buydowns, funky loan products, and marketing lines like "marry the house, date the rate" keep the old story alive. Just get in now. Future, you will sort it out. Future you is already tired, by the way. The truth is simple. The old playbook wasn't evil. It's just outdated. It was built for a different housing world. Clinging to it now is like using a 20-year-old map in a city that's been completely rebuilt. You might eventually get somewhere, but you're going to take the most painful route possible. In this new reality, you can't rely on "that's what everyone does" anymore. You need a new playbook based on numbers, margin, and long-term resilience, not nostalgia for a market that doesn't exist. Number 9, monthly payments. Exploded, but prices didn't crash. One of the most confusing parts of this market is that it feels like everything should be cheaper by now. Rates went up, affordability dropped, demand cooled in some areas. So where's the big price crash everyone on the internet promised? Instead, a lot of buyers are staring at listings that look suspiciously similar in price, but the monthly payment has gone through the roof. That's the flip right there. The real squeeze isn't just the sticker price. It's the cost of carrying the house each month. A home that might have been tight but manageable at a 3% rate becomes absolutely not at 6 to 7%. Same house, same neighborhood, same flaws in the kitchen, completely different financial reality. This is why so many people feel like they missed the last train. They're not wrong. A buyer from a few years ago and a buyer today could be looking at the exact same house, but today's buyer is paying hundreds, sometimes over 1,000 more per month for nothing extra. No bigger yard, no extra bedroom, just more money siphoned off into interest. And while prices have softened in some places, they haven't universally fallen off a cliff. Sellers are anchored to what their neighbor got in 2021. Markets are sticky. Investors are still around. Inventory is weird, so buyers are getting hit with a double punch, stubborn prices plus higher borrowing costs. So when people say, it just doesn't feel like a good deal, they're picking up on the math, not being dramatic. The payment explosion without a corresponding price collapse is exactly why this market feels broken. You're not paying extra for a nicer home. You're paying extra for a more expensive money environment. In the old days, the advice was, stretch a little now, it'll feel easier later. In this environment, stretching can mean living in permanent tension, hoping nothing in your life gets even slightly worse. That's not a plan. That's a stress subscription. Number 8. Marry the house, date the rate is dangerous. Now, this little phrase needs to be retired with honors and then gently buried. Marry the house, date the rate became popular when rates were low and everyone assumed that if they ever did go up, they wouldn't stay there long. The idea was simple. Don't worry about the interest rate too much. Just get the home and you can always refinance into something better later. That logic made sense in a world where rates trended downward or stayed low, prices rose steadily, refinancing was cheap, easy, and likely to work in your favor. We are no longer in that world. Now you've got a lot of people buying homes at very high monthly payments, telling themselves a bedtime story. Future me is going to refinance and fix all this. Future them is currently looking at the rate sheet going, yeah, about that. Refinancing only helps if rates actually drop your income and credit still qualify your home value holds up or increases. The savings outweigh the closing costs. None of that is guaranteed. And if rates don't come down meaningfully, you just locked yourself into a painful payment based on a meme. That's not dating the rate. That's signing a long-term lease with it and hoping it matures. The danger of this phrase is that it encourages buyers to ignore the present reality of their finances. Instead of asking, can I comfortably afford this payment if nothing changes? They're asking, can I survive this temporarily until some magical future event saves me? It's fine to hope rates improve one day. It's reckless to require them to. In this flipped market, the smarter mindset is closer to, if this payment never improves, could I still live my life? If the honest answer is no, then it's not a house you're marrying. It's a long-term financial problem you're bringing home and introducing to your future self without consent. Number 7, sellers are locked in, so inventory stays weird. A big part of why this market feels so twisted is what's happening on the other side of the table, the sellers. During the low-rate years, millions of homeowners refinanced into mortgage rates that now look like typos, 2%, 3%, sometimes under that. Those people are not in a hurry to give that up. To sell their current home and buy another one, they'd be trading a tiny rate for a much larger one on a more expensive property. That's not upgrading, that's volunteering for a higher monthly bill in an unstable world. So what do? They stay put. The result is a kind of inventory freeze. The people who would normally sell, move, downsize, or trade up decide, you know what, we'll just stay where we are. That takes supply off the market. For buyers, this creates a strange reality. There are houses for sale, but fewer than there would be in a more normal cycle. Some of what's on the market is the stuff nobody really wanted in the first place, overpriced, awkward, or needing work. The few truly desirable homes can still spark competitive situations, even in a so-called cooling market. So you get this confusing mix where headlines talk about slower sales and higher rates, but on the ground, buyers still feel pressured and limited. When sellers are locked into low rates and refuse to move, the whole market becomes sticky. Prices don't fall as much as buyers hope because not enough fresh, fairly priced inventory hits the market to reset expectations. This is why waiting for a dramatic flood of listings can feel like waiting for a package that never left the warehouse. It's not coming, not unless something forces a large number of people to move, and that's usually not the kind of event you want to root for. The locked-in seller problem means buyers are shopping in a half-stock store with full-price tags. The shelves aren't empty, but they're not exactly overflowing either, and that imbalance quietly keeps buyers on the back foot. Number 6, lenders are pushing risk downstream to buyers. The mortgage industry is very good at one thing: adapting to keep loans moving. When affordability gets stretched and buyers are struggling to qualify, lenders don't just shrug and close shop. They get creative. Sometimes that creativity is genuinely helpful. Other times it's basically makeup on a payment that's too high. Enter things like temporary rate buy-downs. Your payment will be lower at first. Adjustable rate mortgages, ARMs, with low initial rates. Longer loan terms in some contexts. Aggressive pre-approval amounts based on the outer edge of what you can technically afford. On paper, these tools can make a brutal payment look almost reasonable for a little while. The problem is what happens after the intro period ends, or when the adjustable rate starts adjusting. That's when the real cost shows up. In a flipped market, the risk hasn't disappeared, it's just been rearranged. Lenders still get their fees, agents still collect commissions, loan products still get sold. But the actual long-term risk of rates rising later, of payments jumping, of being stuck with a home that's too expensive to carry, lands squarely on the buyer's shoulders. And all of this is happening while buyers are emotionally vulnerable. They're worried about missing out, tired of rent, or under pressure from family and social media to finally buy something. When someone waves a pre-approval letter under their nose that says, "You can afford this," it feels like permission. In reality, some of these solutions are less about making the home affordable and more about making the transaction possible. There's a huge difference. The lender's job is to see if you fit the guidelines. Your job is to decide whether this loan fits your actual life. If you don't understand how your payment could change, when it could change, and how badly it could hurt if it does, you're walking into a deal where the fine print holds more power over your future than you do. Number 5, first-time buyers are taking the biggest hits. In almost every tough housing cycle, there's a group that ends up carrying most of the risk, and right now, that group is first-time buyers. These are the people who don't have home equity to roll into a new purchase, often have smaller down payments, are fighting rising rents at the same time they're trying to save, feel intense pressure to get on the ladder before it's too late. It's a lovely setup for stress. In this flipped mortgage market, first-time buyers aren't walking into a gentle on-ramp. They're being launched into a course with higher rates, higher monthly payments, and far less margin for error. A slightly overambitious purchase in this environment doesn't mean we'll tighten our belts for a bit. It can mean we have zero room for anything to go wrong. To make it worse, much of the messaging they hear is recycled from a different era. Stretch a bit now, it'll pay off later. You're young, you'll grow into the payment. Rent is throwing money away. It sounds wise, it feels responsible, but it doesn't fully account for the reality that their starter home payment may now rival what used to be considered a move-up home payment. First-timers are often the most determined. They're also often the easiest to oversell. They don't have past experience to compare to. If a lender says, "You're approved," and an agent says, "You can afford this," it's natural to believe it, but qualifying for a mortgage is not the same as thriving with one. When you mix high monthly payment, minimal savings, no previous homeowner cushion, and unpredictable economy, you get a group of buyers who are one unfortunate event away from serious financial trouble. Not because they're irresponsible, but because the system quietly shifted more risk onto them while everyone still told the same old story. Number 4. Renting versus owning math has flipped in many markets. For decades, the default wisdom was, owning is always better than renting, rent is just throwing money away. In some markets and periods, that was solid advice. You built equity, benefited from appreciation, and locked in stable payments while rents crept up. But in today's flipped environment, that simple slogan doesn't always hold up. In many areas, the monthly mortgage payment on a median-priced home at current rates is dramatically higher than local rent for a similar place. We're not talking a $100 or $200 difference. We're talking numbers that genuinely change your lifestyle. When owning a basic home would cost you, say, $1,000 more per month than renting something comparable, that has consequences. Less money for savings and investments, less buffer for emergencies, less flexibility for career moves or family changes. At that point, rent isn't throwing money away. It's paying for flexibility and liquidity. You're buying time, options, and breathing room while the market figures out who it wants to be when it grows up. None of this means owning is bad. Home ownership still has real advantages: stability, long-term equity, protection against future rent hikes. But in some markets, at today's rates, buying now means paying a premium for those advantages that may not make sense for everyone, especially if your budget is already tight. The smarter question isn't, is renting dumb? It's, given current prices, rates, and my income, which choice gives me the strongest overall financial position? Sometimes that answer is still ownership. Sometimes that answer is renting while you pile cash, improve your income, and wait for opportunities that don't require you to live on the financial edge. You're not failing at adulthood if you run the numbers and realize renting is the better move for now. You're just refusing to play a game where the rules changed, but the slogans didn't. Number 3, refinancing is basically dead. Refinancing used to be the American financial reset button. Bought a house? Refi later. Rates dropped? Refi. Need cash? Refi. It was like the undo button for expensive decisions. Now, that button is grayed out. With so many homeowners sitting on historically low rates, refinancing makes no sense for most people. Why trade a low rate for a higher one just to rearrange the same debt? That's like trading a working refrigerator for a more expensive one that doesn't keep food cold. This killed a massive part of the mortgage industry and created a new reality. Homeowners are staying put. That slows inventory, it freezes movement, it traps people in homes they might have outgrown, because moving means trading up not just in house size but in payment pain. The refi era is over for now, and that's a major flip. Number 2, housing isn't a fast wealth builder anymore. Housing felt like a cheat code for a long time. Buy a home, watch it rise, refinance, repeat. People talked about real estate like it was guaranteed wealth, but higher rates changed the entire wealth equation. When the cost of borrowing rises, appreciation has to work harder just to break even. The free money feeling is gone, mistakes get expensive. Overpaying isn't just a whoops, it's a multi-year regret. Housing is shifting back to what it historically was, a long-term lifestyle choice, not a quick financial flex. And honestly, that might be healthier, less hype, more planning, more realism. Number 1, the old advice is now dangerous. The most dangerous thing in this market isn't the rate, it's the recycled advice. Buy as soon as you can. Marry the house, date the rate. Real estate always goes up. Those phrases were built for a falling rate world. In today's flipped market, blindly following old rules can lock people into payments that squeeze their lives for years. Not because they're irresponsible, because they were misinformed. Today, timing, strategy, and financial cushion matter more than motivational quotes. And the people who win in this market aren't the ones who rush, they're the ones who understand the new rules. We are down to number 1 through the countdown, and that's the flip. Rates changed the math, payments changed buyer behavior, lending tightened, sellers lost leverage, refinancing disappeared, and the old advice became risky overnight. This market isn't broken, it's different, and different markets punish autopilot decisions. Thank you for watching. If this breakdown helped you see the housing market more clearly, do me a quick favor. Hit the subscribe button, turn on notification, and share this with someone who's house hunting right now, because somebody you know is still using yesterday's rules. And I want to hear from you. Are you buying, renting, or sitting out the market? And what's your biggest concern right now? Drop it in the comments.